Good morning and welcome to TOI Japan Market Radio, coming to you from Tokyo on Saturday, January 25, 2026. I'm your host, and this is our daily briefing designed for global investors tracking Japan exposure. Before we dive into the key themes shaping Japanese assets this week, I should note that the Tokyo market was closed yesterday for a holiday. Joining me today is our portfolio manager with a macro focus on Japan. Let's start with the big picture. What's your read on the setup heading into next week?
Thanks for having me. So with markets closed in Japan yesterday, the focus really shifts to the global macro backdrop, particularly what's coming out of the United States. The Federal Reserve is widely expected to hold rates steady at its upcoming meeting, and that decision carries significant implications for Japanese assets across equities, foreign exchange, and rates. We're also seeing some interesting corporate developments, notably Mitsubishi UFJ's designation as a Fed primary dealer, which speaks to the global ambitions of Japanese financial institutions. And then there's this curious dynamic where domestic investors continue to sell Japanese equities even as the market strengthens. So we've got a mix of policy, corporate, and flow themes to work through today.
Let's start with the Fed, because that really does set the tone for so much of what happens in Japan. The headline we're looking at suggests the Federal Reserve is preparing to hold interest rates and essentially lead global central banks in maintaining policy steady. Walk us through what that means for Japan specifically.
Right, so the key point here is that the Fed holding rates reinforces the interest rate differential between the United States and Japan. The Bank of Japan has maintained a much more accommodative stance relative to the Fed, and that gap has been a primary driver of yen weakness and carried trade dynamics over the past year. When the Fed signals it's not in a rush to cut rates, that keeps the differential wide, which continues to support demand for dollar assets and puts downward pressure on the yen. For Japanese equities, this is generally supportive near term. A weaker yen benefits the large cap exporters that dominate the Nikkei 225 and TOPIX, particularly names in autos, electronics, and industrials. Additionally, a Fed that's holding rather than hiking aggressively tends to support global risk appetite, which flows through to Japanese equities as well.
And on the currency side, it sounds like the pressure on the yen persists. How should investors think about that in terms of positioning?
Exactly. The downward pressure on the yen is likely to continue as long as that rate differential remains wide. Carry trade demand stays elevated, and you don't get the safe haven appreciation that might otherwise support the yen in a risk-off environment. The Fed's cautious tone also matters because it reduces expectations for coordinated global easing. If the Fed were aggressively cutting, you might see the Bank of Japan feel more pressure to adjust policy in tandem, but a holding Fed gives the BOJ more room to maintain its current stance. That feeds back into keeping the differential intact.
What about Japanese government bonds? Does this Fed hold have any read-through to JGB yields?
There's modest upward pressure possible on longer duration JGBs. If the Fed is holding and markets are pricing out aggressive rate cuts in the United States, that tends to keep global yields somewhat supported. Japanese yields could drift modestly higher from current levels, particularly if the market interprets the Fed's caution as reducing the urgency for the BOJ to lean dovish. It's not a dramatic move, but it does create a bit of a floor under longer-dated yields, which is worth watching if you're positioned in Japanese fixed income.
Staying with the central bank theme, let's shift to a corporate story that touches on monetary policy infrastructure. Mitsubishi UFJ Financial Group, Japan's largest bank, has been designated as a Federal Reserve primary dealer. This is a significant development. What does this designation actually mean in practical terms?
This is a big deal for MUFG and speaks to its global capital markets ambitions. Being a Fed primary dealer means Mitsubishi UFJ now has direct access to Federal Reserve operations, including open market operations and the discount window. It elevates the bank's role in U.S. capital markets infrastructure and puts it on equal footing with the major global trading houses. For Japan, this matters on a few levels. First, it signals enhanced credibility and operational capacity for MUFG in U.S. fixed income markets, which strengthens its competitive position globally. Second, it reinforces MUFG's systemically important role and improves its ability to source dollar funding and manage liquidity, which is critical for a mega bank with substantial overseas operations. And third, it's actually a policy signal in its own right. The Fed's confidence in designating MUFG reflects structural stability in Japan's financial system, which could indirectly support coordination between the Bank of Japan and the Fed on monetary policy.
How does this play out in terms of market impact? I imagine there's a direct benefit for MUFG's stock, but does it ripple beyond that?
For MUFG itself, which trades under code 8306 on the Tokyo Stock Exchange, this is modestly positive. It supports the earnings outlook through improved capital markets revenue and operational efficiency. The bank can now participate more directly in Fed operations, which enhances both revenue potential and strategic positioning. For the broader market, the benefit is more subtle. If this designation reduces systemic risk concerns around Japanese financial institutions, that's a modest tailwind for the Nikkei and TOPIX. It underscores the health and credibility of Japan's banking system at a time when global investors are scrutinizing financial stability. On the currency side, it's pretty neutral. It reflects well on Japanese financial institutions, but it's unlikely to drive major moves in dollar-yen absent a broader policy shift. Same story for JGB yields, minimal direct impact, but it does reinforce structural confidence.
Meanwhile, in corporate news, there's an interesting flow dynamic emerging. We're seeing reports that domestic investors in Japan are selling equities even as the stock market continues to strengthen this year. That seems counterintuitive. What's driving that disconnect?
It is counterintuitive on the surface, but it reveals a really important divergence in sentiment between domestic and foreign market participants. When you see sustained domestic selling during a rally, it usually points to one of a few dynamics. Japanese investors may be rotating away from equities into fixed income or foreign assets. There could be profit taking after the market's strength, especially if domestic investors are more conservative and want to lock in gains. Or it could reflect a shift in domestic savings allocation patterns, which is particularly important given Japan's aging demographics and the behavior of pension funds. Understanding these capital flows is critical because it tells you whether the market's strength is sustainable or whether it's overly reliant on foreign demand.
So what does that mean for the sustainability of the rally? If domestic investors are stepping back, can foreign buyers fill the gap?
That's the key question. If foreign buying remains robust, the market can continue to grind higher even with domestic outflows. We've seen that dynamic play out in Japan before, particularly during periods when the yen is weak and global investors are attracted to Japanese equities for valuation and export exposure. But if foreign demand slows, domestic selling becomes a real headwind. The sustainability of the Nikkei and TOPIX rally depends heavily on whether external capital can offset those domestic outflows. It's a flow story that needs close monitoring.
What about the implications for the yen and JGBs? If domestic investors are selling equities, where is that capital going?
That's where it gets interesting. If domestic investors are selling yen-denominated equities and redeploying into foreign markets, that could put additional pressure on the yen. You're essentially seeing outflows from Japanese assets, which would weaken the currency. On the other hand, if the rotation is into Japanese government bonds or other domestic fixed income, that could actually support JGBs and keep yields anchored. That would be supportive for the Bank of Japan if they're concerned about normalization and rising yields. The challenge is we don't have complete visibility into where exactly those flows are going, so it's a bit of a mixed picture. But the broader point is that domestic investor behavior is a critical variable for Japanese asset prices across the board.
Shifting back to equities for a moment, let's tie these themes together. We've got a Fed holding rates, which supports the yen carry trade and benefits exporters. We've got MUFG gaining credibility on the global stage. And we've got domestic investors selling into strength. How do you weigh those factors as we head into next week?
I think the Fed hold and the persistence of the rate differential is the dominant theme for now. That keeps the yen under pressure and provides a tailwind for Japanese exporters, which are the heavyweights in the Nikkei and TOPIX. The MUFG story is a positive signal for financials and for Japan's global integration, but it's more of a slow burn than an immediate catalyst. The domestic selling is the wildcard. If that accelerates, it could create volatility, especially if foreign investors start to question the durability of the rally. But for now, the external backdrop is supportive, and I think Japanese equities can continue to perform as long as the yen stays weak and global risk appetite holds up.
On the rate side, are you watching for any specific catalysts from the Bank of Japan?